folks. You want to see some measure of a 15-minute or 5-minute relative equal highs inside of the range that would be in the lower third or 1/4 of the previous day's range when you're bearish. Now, some of you are like, why don't you just do this on a video? Can you just show me? Can you just listen? Because I'm explaining it to you. This is how you learn how to do it. You go into your charts looking for it. And when you find it and you do examples of logging that and having dozens of them as examples, then it's more meaningful because you found them using these rules. Whereas if I just show you a chart, oh, okay, well, it doesn't mean anything to you. You didn't do any work to look for it. But when you see it and you study how it reacted in price after that, okay, we're anticipating that future reaction by price. We aren't reacting to price. We're anticipating price to do these specific things, which is what? If we're bearish in London, you want to look for a single high or a relatively equal, like equal highs, inside of the previous day's lower 1/3 or 1/4 part of the daily range of yesterday. Whatever the yesterday is. If it's a Monday, it's Friday's daily range. Otherwise, it's whatever the previous trading day is. That's pretty simple rules, right, folks? So in between 2 o'clock and 4 o'clock, we would anticipate a rally above those relative equal highs on a 5 or 15-minute chart, whichever one's easier for you to see. Regardless, you'll see it. If you want to use a 15-minute chart as a bellwether, I use that as mine. But you can look at it on a 5-minute basis. And as it rallies above that, what's going to be resting above those relative equal highs or single high? Buy stops. And the characteristic for the London session is to run up and entice traders to chase it going long. When in fact, it's a function of running into buy-side liquidity for smart money to absorb those buy stops and be counterparty as they flood the market with buy orders. Shorts are entered by smart money there because it's a run on liquidity. It's engineered to provide a entry mechanism for smart money to go short. It takes a lot of confidence to take that type of trade because usually in London, the Judas swings are very violent and they're quick. And it feels like it's going to go up 100 pips. It's going to go up, 80 handles on the S&P. Look at this thing move, man. Wow, it's going up 12 handles. Look how fast it's moved. This thing's going to keep on going. If you feel that way, you're reacting to price. When we're looking for that to be a run real quick to get to those stops so that stops can't be pulled. And once that happens and the orders are not pulled by the traders that have those orders resting there, we anticipate price rejecting there and going lower. Now, if you can't take that type of trade or entry in the beginning, you won't. Let's just be fair. I say this all the time. Buying sell stops and selling short buy stops is one of the hardest things to do as a trader because at the time when it happens, it's fast, it's furious, and it's scary. And you have to know what you're looking for, which is why you have to anticipate and predict the future. You have to. Profitable trading is predicting the future, folks. I don't know why you want to argue with that, but that's what it is. Reacting to price. Okay, you reacted to what it did and you entered into a trade. Now what? You just let whatever the wind carry you in the current without a rudder. You just, whatever happens, man. Stuff's all random. If that's how trading really is, to hell with that. I'm never going to do it. I would never do that. Anybody in their right mind that would go into a venture like that, risking money, saying, well, you just got to see what happens. You know what that did for you when you start your demo trades, right? You get out there, let me just push the button. I'm bored. Let me see if I can make $5,000 in 10 minutes. And you lose. So you know that mentality, what it does for you. And it's not going to change with real money. Let me see what happens if I push the trade on. Boop, there it is. I got funded. I got through the portion of where we pass it. Now let me see if I can just make one of those real quick 5-figure withdrawals because, if I get one of them, that'll be enough to carry me through, even knowing that I don't know how to trade. And you wrestle with all that stuff because you're trying to do stuff that you're not prepared to do. You don't know how to anticipate. You're reacting, but you call it anticipation. You may share it with the community and me that you found a trade, but you're probably not being honest about what you felt the entire time you did it. It was just that one that panned out for you. So I'm not trying to encourage that type of thing in our community or in any of my students. You need to be 100% honest. And if you're struggling, find out what you're struggling on. But having a time-based approach helps you identify where your problem areas are. If you're not trying to trade at a very specific time of the day, how are you going to be able to measure your progress? How could I fix your issues for you if I was to sit down with you? I'm not making this invitation for you folks. I'm just saying, if you were granted the opportunity to sit down with me one-on-one, side by side, right next to each other and say, okay, ICT, here's my problem here. I'm doing this. I took a trade in London and, this, that, and the other thing. And then I saw this trade in New York and I was doing this and doing that. And then, I made some money there and I was like, I want to go into the afternoon session. I'm going to trade the last hour in S&P. And then I lost everything. What am I doing wrong? Number one, you're over trading. Two, you're not being a specialist. You have to be a specialist in terms of what market you're going to trade and what time of day you're going to trade. See, in your mind, you're thinking, wow, I can trade the London session. I can trade the New York Open session. I can trade the lunch hour when they run on stops. And then I could do the PM session. And I got the two silver bullets in the AM session, the PM session. Good grief, I can do this. And all of a sudden you're top of the leaderboard at FTMO and you're winning the Robbins Cup and you're blowing everybody else away on social media. And I get it. I know that's what everybody wants to do. But you can't do that. You're learning all of this at your own pace. And some of you, if not all of you, are not providing the permission that you yourself require of yourself to take whatever time is necessary for you to learn how to do this. Books, authors, teachers, mentors, courses, products, none of that is going to remove the impact that you yourself bring to this. The learning curve is going to be whatever it is for you, however long it is, because of who you are and what you wrestle with. And pretending that you don't have any of these problems that I talk about and other traders may refer to is nonsense, because there is no perfect student of the market that came in with no baggage or no mental barriers. Everybody has their own things. And some of them may not be a point of which where you overcome them. And it might not be feasible for you to do this. And then you would have to submit yourself to someone that does it really well and you buy their signals or setups or their product. And in that case, I don't think that's wrong. I don't, if someone can prove that they have something that works or they have a signal service that does well and you can't do it yourself, I don't think there's any shame in that at all. There's no shame in that because it's difficult, folks. You're the deciding factor in whether you're going to succeed or not. It's not the thing that you're using. It's you. It's you and what you are willing to do and what you're not willing to do. So in London, you're looking for false breakouts and runs above relative equal highs when you're bearish, or a single high that is inside of the previous day's range. Now, I know there's no chart here, but I want you to think about it conceptually. Let's look at it like this. If you have note-taking instruments in front of you, this should be an easy thing for you to do. Let's just say, hypothetically, you draw a rectangle, leaving room for a rectangle to the right of it, okay? So you're going to draw a rectangle, and at the top of that rectangle, you're going to say 100 is the high, and the low is 20. So you have a previous range of 80 units. It could be pips, it could be points, it could be whatever. But we're going to say it's 80 units. Then you're going to see where you open up at 2 o'clock in the morning, New York local time. Wait a minute. What do you mean open up, ICT? Wait. Look, you just said, and I understand that the market starts trading at 6 o'clock. What are you talking about opening at 2 o'clock? Yeah, now we have a new opening range. 2 o'clock's opening price. What is that? The first opening price on the first 1 minute candlestick at 2 o'clock, New York local time. You want to note that. Now that's an important price point. From that price point, you want to see it be, if you're bearish, you want to see it be below the 20 level of the previous day's range, because that's what that rectangle would represent. And that's, for example, let's just say at 2 o'clock on the trading day that you're in right now, say it's 18 in reference to the previous day's range. So now you're below the low of yesterday's daily range. So from 6 o'clock all the way now to 2 o'clock in the morning, the market has done whatever it's done. If those highs, that relatively equal high or a single high in the previous range between 20 and 80, if there's a single high or relative equal highs in that lower 1/3 or quarter point of that previous rectangle that you're drawing out, that represents the previous day's trading, you're anticipating at 2 o'clock in the morning on the trading day that you're watching price at right now, you want to see a Judas swing shoot up. You're going to anticipate that. You're not going to react to it. You're waiting for it. You want to see that very thing happen. Now, as an ultra short-term scalper, you can buy that, but you have to be very nimble because it can go up there and turn on a dime quickly, because London is a false breakout characteristic time period. When it runs up there, why are we anticipating a run back into the previous day's range, but only the lower quarter or 1/3% of the range? Because we don't think that the previous day's high is going to be taken out. And we don't think that half of the previous day's range is going to be a factor at all. The best shorts are going to occur in the lower half of the previous day's range when bearish.